Tom Bowley, Chief Market Strategist here at EarningsBeats. Hey, good morning, everybody. Hopefully you're having a good day. I know the market had a great day yesterday, and we're going to get into all that here in just a minute. But let me first just handle a couple things here. Just running a minute behind. So this is Trading Places Live for those of you that are new. It is Thursday, December 14th, 2023. We do this 3 times a week, Tuesday, Wednesdays, Thursdays, in case you're not aware. 9 a.m. Eastern is when we get started. And then we do a live trading room with our members at 10 o'clock on Wednesday mornings. If you're not familiar with me, I'm Tom Bowley. I'm Chief Market Strategist here at EarningsBeats, and it's a pleasure to be with you again this morning. Well, I mean, yesterday, what can I say? I've been talking about the fact that you really don't want to short a bull market. We had a lot of different signals that said, hey, we got to be a little bit cautious, right? I mean, we had the worst week of December historically since 1950 on the S&P 500. December 11th through December 15th, historically, one of the weakest periods. We had negative divergences. We've seen them on the NASDAQ. We've seen them on the S&P 500. We had a Fed meeting, 2-day Fed meeting concluded yesterday. We had 2 big inflation reports. We had on Tuesday, we had the November CPI. Wednesday, we had the November PPI. Options expire tomorrow. I mean, there were so many things that were being thrown at the market, and the market just withstood it all and just kept moving further and further to the upside. And yesterday really culminated what's been a spectacular week for U.S. stocks. And I mean, we still look really good in the growth areas, but we're seeing the value kind of taking over. And this is typical for the month of December. We're going to talk about that a little bit today. So let me go ahead and get things going here. And we'll start off taking a look at what happened in the market yesterday. So here we go. The Dow Jones, and I didn't quite get all the chart set up. That's why it's a little smaller today than it was yesterday, but we got plenty to talk about. Trust me. The Dow Jones Industrial Average yesterday up 512 points, back above 37,000. That's up 1.4% yesterday. The S&P 500 shot up 63, clearing 4,700. Remember 4,600, big resistance? Well, yeah, that's gone. Over 4,700 now. And within, we're not far from an all-time high on the S&P 500. 4804 was the high. I don't remember if that was the open or the close. I think the intraday high was 4818. I mean, 4707, we're pretty darn close to that all-time high. And meanwhile, that 2022 low, 3491, that's looking quite a distance back in our rearview mirror. The NASDAQ 100 gaining 208 points, 16,562, zeroing in on its all-time high. Mid-caps, big jump in the mid-caps, up 2.5%. But the winner yesterday was clearly the small caps. And I mean, the small caps were lagging early in the day. The small caps have been lagging all week, and they made up for it in 2 hours. IWM absolutely soared after 2 o'clock yesterday, gaining over $6, which was 3.4%. I said 190 was going to be the area that it probably was going to gravitate toward. Well, went right through 190 like a hot knife through butter. And now really the 198, 199 area where we've seen multiple tops in 2023, that's the next level for the small cap IWM. Transports did okay, up 1.25%, maybe on a relative basis, lagged a little bit, but we did get another break in the short term after going back, testing that 20-day moving average or nearly testing it. Here we've come right back up to a new high. Very bullish action on the transports. But here's where it gets interesting. Look at the leadership yesterday. So all 11 sectors went higher. Utilities, the leader, 3.78%. Real estate up 3.6%. The laggard was technology, only rising 0.9%. So I know, I've got some detractors out there, and I know the first thing they're going to say is, okay, this rally is being led by defense. True enough. I got nothing for you there. What I can say, though, is that all these other groups have already broken out. Utilities and real estate was lagging, and these are more defensive, value-oriented areas of the market that historically lead during the month of December. That's the difference. Historically, and I'm going to show you some charts a little bit later in the show, but we normally see this with value-oriented stocks. They lead in the month of December. Now, I don't want defensive stocks to absolutely soar and aggressive stocks to not participate. So we want to kind of have a balance there. But one day of seeing utilities and real estates on the top, actually, I feel a little bit better about it because, I have heard so many battles over the last year or two when the market's gone up that we don't have enough breadth. Market's missing breadth. Well, those that are worried about breadth can now jump on board, I guess, because that's when you start going into other areas of the market and getting leadership there, that's when you're going to start seeing more and more breadth support this market. I think breadth is a confirming signal. I do not believe breadth is a leading signal. And so for me, that's what I think the difference between me and a lot of technicians that like to use breadth is a lot of times it's not until after a big run's been made before you actually see the breadth begin to support everything going to the upside. So if you're waiting for that, you miss the whole rally in 2023. So that is part of the problem I have with breadth. But anyway, I'll be done with that. I thought the overall action yesterday was phenomenal, especially in light of all the things that we've talked about. And I keep telling members, if I'm in a bull market, I won't short. I do not like to short because I've seen bull markets before and they just ignore everything and they just keep going higher. That's exactly what happened yesterday. It didn't matter about the week of December. It didn't matter about the Fed meeting. It didn't matter about inflation reports. It doesn't matter about options expiration. Market just wanted to go higher, and it did in a big way yesterday. 10-year Treasury yield. So this is another thing that was certainly leading or helping utilities and real estate to lead. Both like lower interest rates. Utilities, if you think about it, utilities are a defensive area. They pay nice dividends, so they're great for income-oriented investors. But the problem was the 10-year Treasury yield had moved up to 5%. So all of a sudden, if you're an income investor, do you want to go into a utility where prices fluctuate? Or you can lock in a 5% 10-year Treasury yield where you don't have to worry. Yes, the value of the bond will change, but if you hold till maturity, you get 5% on your money. So that was pressuring these utilities and real estate. And now that we've seen this big drop here, and especially the big drop yesterday with another breakdown, look at the 10-year Treasury yield today, by the way, 3.97%, down another 6 basis points. Yesterday, it was down 17 basis points. We talked about that topping head and shoulders, the fact that we had the initial measurement to 410. We bounced off of 410. Did we go back through the 20? No. Instead, we turned and went to a new low on the 10-year Treasury yield. The stock market is loving all of this. The economic reports that are coming out are still pretty good, decent anyway. And you've got the Fed now talking more dovishly, to be honest. That was the thing that bothered me a little bit yesterday was the Fed going to spoil the party? Because we've seen this before. It wouldn't be the first time, right? Think back to Jackson Hole, of 2022. More pain ahead, remember? Yeah, the Fed's not very good at prognosticating when it comes to the stock market. Think back to Fed Chief Greenspan, irrational exuberance in 1996. Next 4 years were 4 of the best years we ever saw in the stock market. Yet the Fed chief thought it was too high, way too high in 1996. Don't listen to Fed chiefs. Listen, they're brilliant people. They're not technical analysts. They don't know what the stock market is going to do. And that's been clear again with the more pain ahead, because at the time when he said the more pain ahead, we were much closer to a market bottom than we were to a market top. Anyway, I'll leave Fed Chief Powell alone for the most part after that. But I think he did what he should have been doing recently. And the market was looking past the Fed. Stock market's been going up the interest rates went up. Yes, we were in the middle of a correction for a period of time. I said it wasn't going to last. It was a cyclical bear market, or a cyclical kind of a not a bear market, but a correction, and it was going to be short term in nature. And we've seen exactly that. Rates have topped. What did I say back at the beginning of the year about the fourth quarter? Rates coming down, stocks soaring. I mean, are we not seeing rates coming down and stocks soaring? I think if you look at the story that the charts are telling you, not just last week's numbers or whatever, but really take a step back, look at the big picture, use perspective. That's when I think you can get a better sense of what the market's going to do. Throw out politics, please. Can we be done talking about politics? I really get tired of people writing in. I mean, years ago, 3 or 4 years ago, or 5 years ago, whatever, it was Trump. You know, how's the market going to go higher with Trump? He's a loose cannon. We're going to have World War III, blah, blah, blah. Market went up. Now the Republicans taking their shots. You know, anybody who's Republican taking shots at Biden, how are we going to go up? You know, we got Democrats in office. I learned when I was about 3 years old not to talk politics. That was one of the things my dad taught me. And I can tell you from looking at history in the stock market that politics and the stock market are not correlated. I mean, I'm not going to go any more into it, but those are just, personal biases. You think that the market has to go up because the person you voted for didn't get elected. That's not the way the stock market works historically. So I don't care who's in office. The one thing I'll say about politics that affects the stock market is when you have the same party in charge of the White House and the Senate and the House, because then you've got more of a skewing, I guess, to one side or the other. We start moving off the center. I think as long as we stay on the center, or somewhere in the center, I think stock market is fine. That's what history tells us. But we do see underperformance when we have periods where one party isn't completely in charge of everything. So anyway, I'll get off the politics too, because I don't talk politics very often on here. But I saw that comment again come up yesterday. This rally can't last because of politics, whatever. I don't pay any attention to that. Anyway, 10-year Treasury yield, as you can see, dropping. Let me tell you about the economic news that came out today. So not only do we have a Fed now starting to talk a little bit more dovishly, they raised the number of rate decreases next year to 3. 3. Remember, they started at 4. And then I don't remember which meeting it was recently, but they went back and they said, okay, we're only going to have 2 rate cuts next year, and started talking about how, we're probably still going to have to raise rates. We're watching, blah, blah, blah. Well, now we're back up to 3 rate cuts for next year. A number of rate cuts in 2025 and some more in 2026. And ultimately, they're looking for the Fed funds rate to come back down somewhere in the 2.5% range. Or maybe it's 2.25, from 5 to 5.5. I mean, that's a big deal over the next few years. So we've got that interest rate reduction cycle coming, which we've talked about. I mean, inflation's coming down, growth is positive, but it's not exactly off the charts. And I think most economists are saying 2024 might be a little less in terms of GDP than 2023. And so the Fed it's the perfect storm. The Fed can lower with rates, with inflation coming down and with growth somewhat sluggish. They can be much, much more dovish and accommodative. And I think we're going to see that. And I think that's what the market reacted to yesterday. But listen to this. Okay, so first we had jobless claims. They were expected to come in at 223,000. They came in at 202,000. 20,000 below expectations. Good for the economy. Let's then take a look at retail sales. So for November, retail sales came in. They were expected to the top line. Retail sales was expected to drop by 0.1%. They rose by 0.3%. Pretty interesting, because retail sales go up more than expected. If you strip out vehicles, they go up 0.2% versus consensus estimate of -0.1%. I mean, the numbers are good, and yet with lower initial jobless claims and with a better than expected retail sales report, Both of those normally we'd see rates go up. And instead, the 10-year Treasury yield's down today. I don't know what else to say. I mean, bears. I mean, what's your argument? What are you putting your hat on now? Honestly, if I was a bear in this market, I'd have to throw my hands up and just say, "Uncle." I mean, do we need to see all-time highs? I mean, is that going to do it? Are we still going to have the bears out there? I mean, I don't know how you make money in this market being bearish, but anyhow, so economic report's good. Rates coming down, inflation coming down. This is nirvana for equities. I mean, at some point we're overbought. We'll have a pullback, but I see the market going higher into the year end. I said if we could withstand this week, then I think we could target higher than the 4,700 level that I said back in January. I mean, I would not be surprised at this point if we just don't power to all-time highs on the S&P 500 before the end of the year. I think it's just as good a chance of doing that as moving back to 4,600. So anyway, let's keep moving. S&P 500, here was that move yesterday. Remember I said eventually you can eliminate these negative divergences? Well, if we have another day or two of strength, that negative divergence is going to be gone, which is why I keep stressing that this is, number one, a secondary indicator, not a primary indicator. A lot of people, as soon as they see a negative divergence emerge, they want to just start shorting. It's too early because you don't know. A lot of times when we first break out after an uptrend and consolidation, a lot of times when you first break out, you're going to have a negative divergence. I mean, it's just the way the market works. It's the way the numbers work. These are formulas. This isn't anything. This isn't a magic potion. It's a formula. The default PPO is the 12 period versus the 26 period EMAs. That's all it is. It's plotting the difference between the two. When you're in a rally, the short term 12 period moving average goes up faster. It responds quicker than the 26 period. So as we start these big rallies, you can see the difference between the 12 and the 26 period moving average shooting to the upside. And then after we've done it for a while, the 26-day starts catching up. And then if you go into a period of flat, the 12-day starts to flatten and the 26-day is still coming up. That's what generates a negative divergence. Well, when you break back out again, you don't know where you're going. You don't know how far this rally is going to go. So you got to be careful about calling and acting on a negative divergence too early. I think these last 5 days are kind of showing you why as we're moving back up. Now, if we get a reversing candle or some other kind of corroborating technical evidence, then I think we may have something in the short term. But until then, I mean, as long as we keep putting in higher highs and higher lows, it's hard to get bearish or even short-term cautious. Well, I shouldn't say that because I'm already short-term cautious, but I wouldn't short. What I was talking about was recognizing some of these other signals, staying long the market, but just for me anyway, staying away from leveraged ETFs, options, and so forth. Now, if you stuck with it, you did really well, but you did really well in a high-risk environment. Don't forget that. I prefer to try and do that when I'm in a lower risk environment where I'm near key support, something like that. But it was a great day all the way around, no doubt. NASDAQ 100 back above 16,500, actually getting up at the high to 16,581. So pretty close to 16,600. Beautiful move up. And like the S&P, it has a negative divergence, but it may simply be eliminated. I'm looking back. I mean, I would probably say maybe this one right here where we had a big move. We only consolidated for a little bit, and then we broke out. But if you look at this candle on this breakout, that PPO is lower. So we had a negative divergence back second week of June. But look what happened. It kept going higher. And what happened to the divergence? When you look back now, if you try to tell somebody that the negative divergence didn't work, they would say, oh, there's no negative divergence, right? We've got higher PPO. There was no negative divergence. Well, there was on the breakout. It's just that it got eliminated. And that could happen here. We'll see. But again, for me, the worst thing in the world is to short a bull market and watch it keep going higher, because I called a bull market. I've been bullish all along. That's really dumb for me to be shorting, losing money when the market's going up. I know there are a lot of traders like to try and catch things both ways. That's fine. If I get cautious, I just try to bring a little bit of risk off the table. I don't turn bearish. I don't start shorting. I didn't short from July to October, not once. I just didn't think it was appropriate. I felt like we were in a long-term uptrend and that was going to end. I mean, July to September, historically, and we went all the way into October, but July to September is the worst time to be in the stock market. And most of that selling occurred from mid-July to the end of September, which is that time frame. So seasonality, which picks up, becomes bullish on December 28th. I mean, literally right on cue. That's where this all started. So seasonality has been pretty strong in predicting what's happened so far in 2023. IWM, look at that move. Now I want to show you, actually, yeah, I think I can show you here. I might have it saved in one of the later charts. Got about 9 minutes left. Let me just, we broke through the 187, 188 level, which was nice. This 190 level, I actually thought maybe we'd go to 190 and then maybe have one more pullback to the 20-day. That would be symmetrical right there. I mean, the thing is, it wouldn't be it's not really it wouldn't have been a head and shoulder bottom, because you don't have the bottom of a head and shoulder start. I mean, from a reversing head and shoulder, you don't have it start from a high, which is where the IWM was. You could say, well, okay, off of an uptrend, then it's an inverse head and shoulder potentially. And I would say, no, not really, because when you go have an uptrend, an inverse head and shoulder, the head should never go back down below 50% of the uptrend. This went all the way below the uptrend. So the pattern really didn't make sense. But to most technicians, I think moving back down from this resistance level would have made a lot of sense. And so I thought maybe that's what we were going to see. We did not. We went right through it. Futures, by the way, they were higher, and the IWM was doing better by far than the others. But let's see, diamonds right now. Diamonds are up 0.5%. Spider up 0.5%. QQQ up 1/3%, so lagging a little bit. And the small cap IWM up another 2% today, 1.9%. So it's up. It was up 633 yesterday. It's up another 371 today, $3.71. Right now we're at 197.04, and we're going to open in 7 minutes. And 197.04 puts us, let's go back a couple years here. But just like that, the small caps are up here challenging this multiple triple top that we saw in August of 2022, early February 2023, and then late July before we had that correction, also in 2023. At the open today, we're going to be very close to that. And if you see 200 print, and that ain't far away, you see 200 print, we could be on a massive rally in small caps up to that 240 level to test the all-time high. Would not surprise me. This is the time of the year when small caps do outperform. And I'll talk about that more in just a minute. Transports went back down. That 15,200 level held yesterday again. And then we had a big rally into the close, breaking out again. PPO looks good. I got no problems, no complaints on transports. I think they look good. All right, moving into the chart of the day. I do want to mention a couple things first here. Number one, we are going to have a very big announcement. We are going to be passing along this announcement to our members first on Saturday, this Saturday, 2 days. But it is going to be announced sometime during the day Saturday. If you want to get that early announcement, 30-day trial membership. All you got to do is be a member. You don't have to be a paid member, but a trial member will work. Give us a shout out. Give us a chance. I think our members are pretty happy with what we've called over the years. Our guidance, our education, our research. I think it's all top notch. Any of you watching the show, reading my articles, I think you get a sense of the type of information that we put out at EarningsBeats. But sign up for that 30-day no-cost trial, because you'll get that big announcement on Saturday. For the rest of the public, it's not going to be until the beginning of next week sometime. that we give that announcement. So if you want the early announcement, got to be a member. Got to be a member for some things. Anyway, if you are new to Earnings Beats, you've got a Earnings Beats Digest newsletter. It's our free newsletter. Name and email address is all it takes. No credit card required. You can unsubscribe at any time. Literally, we have tens of thousands of people that have subscribed to Earnings Beats Digest. We think it's a great way to give back to the community, along with these shows, along with the articles. I mean, we do a lot to try to educate. If you want to take your education maybe to another level, sign up for that EB Digest, and we'll be sending those out to you Monday, Wednesday, and Friday. Today is Thursday, however, and so I usually come up with some other kind of a chart of the day. And so I wanted to show you that IWM versus QQQ chart. So over time and over long periods of time, really, we've seen during this secular bull market, not all secular bull markets, but during this one, the IWM small caps have underperformed. You can just see in 2023, this is the relative performance of the IWM, which tracks the Russell 2000. That's the 2,000 smallest companies in the Russell 3000. So it's a lot of small companies. And it tracks it relative to the QQQ, which houses 100 of the largest cap companies, mostly in technology and in discretionary communication services, other areas as well, not financials. Financials are out, but there are some other areas of the market, but it's really dominated by technology, discretionary, and communication services. Anyway, this is just telling us, beating us over the head, that for the last year, small caps have underperformed. If you've been following anything in the market, I'm not telling you anything you don't already know. But I have noticed that since mid-November, or maybe since about the 10th of November, when we hit a bottom, we have been rallying on the IWM versus the QQQ. Now, we went through about a week where the IWM was underperforming again, looked like it was rolling over. And I'm going to show you a 5-day chart, show you what that was looking like. So here we were, IWM versus the QQQ. Last Friday, kind of topping, and then there was Monday, there was Tuesday, there was Wednesday, all going down. And look at what happened at 2 o'clock yesterday. All of a sudden, all of the relative strength that we saw, or actually relative weakness that we saw throughout, since last Friday, all reversed in 2 hours. And we actually moved up to reach that high. That's how furious the rally was at the small cap level. Now, I want to show you small caps. This is small caps versus the QQQ for the last 20 years. You can see on the slider. Now, I want you to see there haven't been a lot of months where small caps have a history of outperforming. But if you see the one over here to the right, 65% of Decembers since 2004, we've seen the IWM outperform the QQQ. That's 13 of the last 20. And this goes back to 2004. I mean, we could drag this back, and I could go back and just look at those years before 2004. Here's the 4 years. And look at December, 75%. Look at the average outperformance in those 4 years, 6.9%. So now let's go back and drag this. And we go last 20 years, and we've got 1.2% average. Those 4 years, the average was 6.9. So we could go back 24 years and say, somewhere above 65%, because those other 4 years, remember, it was 75%. So 3 of the 4 years, December was a stronger month for the IWM than it was for the QQQ. So anyway, we're north of 65%, and we're certainly north of 1.2%. But December has been the best month historically for small caps, at least this century. And so am I surprised that the IWM is showing strength? I'm not. And if we break 200, you might see a lot more relative strength in the small caps through year end. So just want to kind of mention that. Another thing I want to go through, there's 1 more minute left. Here's the S&P 500 going higher. And I wanted to show you more growth oriented versus value and where we stand, because long term, I like to see growth versus lead value. Short term, we have to recognize periods when value tends to take that leadership role, which is where we are now. But look at the QQQ versus Spider. Been in a long-term uptrend throughout 2023. XLY versus XLP, discretionary versus staples, offense versus defense. I mean, it looks to me like it's been going up pretty much all year. IWF, IWD, large cap growth versus large cap value, up all year. Again, another measure of large cap growth versus large cap value is the Dow Jones US large cap growth index versus the Dow Jones US large cap value index. What's that ratio doing? Going up all year. How about mid cap growth versus mid cap value? Going up all year. Small cap growth to small cap value, that's where we've seen maybe more flat action throughout the year. But since early November, we've seen that pick up. So we've seen money rotating a little bit more into growth areas in that small cap arena since the beginning of November, since this rally started. I want to keep going though, because here is your sector summary again for yesterday. What did we see at the top? Utilities, real estate, healthcare, consumer staples, all for defensive stocks or defensive sectors. What have I said going into December? I said I thought this market could be led by value because that's what we tend to see, our value stocks. So taking some profits in some more aggressive areas and maybe reinvesting in some more value-oriented areas that have been beaten up kind of makes good sense to me. I mean, that's certainly one thing to be thinking about. I know most of this year, I really haven't looked too much at defensive stocks because they've underperformed much of the year. I do think they have a chance of outperforming here in December. Already had a great day yesterday. So I think this is an area where you could see bigger profits over the next few weeks. IWF versus IWD. So this is I showed you that IWF IWD ratio. Here's the seasonality. Look at December. This is growth versus value going back 20 years. December growth underperforms by an average of almost 1%. And you go back and the only other month that's negative is September. This is the time of the year when we tend to see value outperform. The SPY growth versus SPY value. You take these two. December, look, November and December, minus 0.3, minus 0.5. October, minus 0.1. September, minus 0.4. You get toward the end of the year, value tends to outperform. Every other month, except April, which is minus 0.1, every other month, the growth areas within the spider outperformed the value areas. We're in a sweet spot historically for value stocks. Don't be shocked that we saw defensive groups lead yesterday. It's okay. Now, if we're still talking about this in February, market's still trying to go higher, but it's really starting to struggle, and we're starting to get some other signs, negative divergences. Maybe the market is just so crazy bullish, equity only put call ratio. Maybe it drops back down. We get 5-day readings back in the, near 0.4 or 0.45. There could be other things that could drive the possibility of a more significant market top, but we are not there right now. I would not try to assume, bears try to grasp onto anything they can, and bulls do the same thing. Listen, I've been bullish and I've been bearish. I think everybody that follows me knows that I will be objective. Some of you think I'm a perma bull. Go ahead. I don't care. Perma bulls don't call cyclical bear markets before they happen. Perma bulls don't talk about in July that we got problems with multiple issues. I mean, go back and read the articles. Look at my YouTube videos. Back at the beginning of 2022, I said the market was likely going to have a very, very rough first quarter. What did the market do? It had a very rough first quarter. Kept going down, and when we got to June, I said the market bottoms in. I mean, those are documented. You can use indicators to help you from both a bullish and a bearish standpoint. You just have to eliminate the biases and just follow the story that the charts are telling us. Anyway, that's what I try to do. Let's see what the market is doing on the open here. We got the Dow up 0.25%. We got S&P up a little more than half, 47.34 now, getting closer and closer to 4,800. NASDAQ up 0.2%. Small caps Small caps are barreling higher, up almost 3 percentage points today. I got to look at the IWM before we wrap this up. It is now at 199.37. Just going to leave it at that. Everybody have a great rest of your weekend. Again, big announcement coming up on Saturday. You definitely want to subscribe. Check us out. 30-day free trial. That'll take you right into the beginning of next year. Perfect time to be a member for no charge, and then see what you think of our service. Also, I want to thank all of you that have supported us, not just in 2023, but really since we've been in business. Hit that like button. Even if you can't subscribe or don't want to subscribe, you can still help us. Hit the like button, hit the subscribe button, subscribe to our channel. Those things will help us in terms of our algorithms and so forth here at YouTube and help build our community. Anyway, have a great weekend, everybody. See you next week. Happy trading.